Good morning, and welcome to the Wisconsin Coalition of Annuitants Virtual Conference. I am Diane Wilsinski, current chair of the WICOA board. Every year we hold our conference to bring you up-to-date information on the Wisconsin retirement system and issues that affect our members. I hope you find the sessions today beneficial and share the information with those in your organizations. The Wisconsin Coalition of Annuitants consists of statewide and regional organizations representing retirees in the Wisconsin retirement system and may include active as well as retired participants in the system. The coalition exists to represent all of the approximate 238,000 Wisconsin retirement system retirees of the more than 663,000 system participants. Each member organization designates representatives to attend monthly meetings of the coalition, where guests from the State Investment Board, employee trust funds, and legislative leaders and members of boards and commissions provide input to active discussions on retirement issues. I would like to thank the guest speakers in advance for participating in this event. I would also like to thank our annual meeting committee members, Bob Schaefer, Sandy Drew, Roger Springman, Jeannie Stengel, and especially our webmaster, Rick Wojak, for their exceptional efforts in making this happen. I would also like to thank the panelists that are with us today. As part of this virtual meeting, you will be able to ask questions by pressing the Q&A button that can be found on your screen. Just click the symbol and type in your question. Bob Schaefer will be the moderator and will collect the questions and present them to the speakers on your behalf. Speakers will respond to the questions at the end of their presentation. Please do not use the chat button. Finally, please complete the survey when you leave the conference today. Thank you. Our first speaker is Mr. Edwin Denson. Mr. Denson is currently the Executive Director, Chief Investment Officer of SWIB. The appointment was made in April of 2021 after he joined SWIB as Managing Director, Asset and Risk Allocation in 2018. Edwin holds a bachelor's degree in economics from Cornell University and a PhD in economics from Northwestern University. Mr. Denson will be assisted by Rochelle Kalaskin, Deputy Executive Director and Chief Administrative Officer of SWIB, and Todd Mattina, Head Economist, Asset and Risk Allocation Chief Investment Officer. Welcome, Edwin, Rochelle, and Todd.
Hey, well, thank you very much. Really appreciate that. And it is an honor and a privilege to be able to address you all today. If we could get Todd, if you could please share.
Is that working?
No, not quite yet. We see you. There we go.
Excellent.
Yeah, thank you very much. If you could please move to the next slide. So the agenda today, I'm going to be speaking to you about performance and asset allocation. Then I'm going to turn it over to Rochelle to talk about cost effectiveness, and then over to Todd to give us an economic outlook, and then back to Rochelle to give you an update on what's been going on with SWIB. And then finally, we will take questions at the end. So again, we'll start off talking today about performance, and I'll start with, first of all, just taking a look back at calendar year 2023. The core trust fund delivered very strong absolute return of 11.4% for the calendar year. And that's important to help us overcome the bit of a speed bump that was created by the negative return that we had posted the previous year, and that was 2022. Our longer term performance numbers, so our 5-year and 10-year returns, exceed the 6.8% actuarial return, which represents our target for keeping the retirement system fully funded. and to maintain stable contribution rates and provide consistent positive annuity adjustments. Now, 2023, although it was a very strong year in the end, again, 11.4%, it was quite a roller coaster ride. Through the first half of 2023, it looked like we were going to have a modest year at least, and perhaps even better, with the core trust fund having returned 6.5% by the end of June. But then came the third quarter, and to be more precise, the 4-month period from the end of June through the end of October. And that's when interest rates really skyrocketed and asset returns moved correspondingly, meaning they went down across the board. So by the end of October, the core trust fund return had come down to just over 2% for the year to date, compared to that 6.5% that we'd been tracking in the middle of the year. And then again, a roller coaster ride. Fortunately, the last part of that was a big up move. So the last 2 months of the year saw a confluence of very favorable market developments, including a downward trend in inflation, continued strong economic growth, and signals from the Federal Reserve that further interest rate hikes were highly unlikely. And the impact of this on capital markets was decisive and very significant. So from that paltry 2% that we were, again, tracking at the end of October, we ended the year with the core trust fund up over 11% for that year. That's a solid outcome indeed. That was in no way guaranteed. On the screen here, you can see performance for the first quarter of 2024, close to 3.5%, and that's a very strong start to the year. And I'd also like to point out, in particular, that the 3.5% represents an outperformance of about 60 basis points or 0.6% over our benchmark, which returned about 2.9% in the first quarter. And again, those longer term numbers continue to show very favorably versus that actuarial target, which is what we need to return to keep the overall retirement system stable. You can move to the next slide, please, Todd. Turning to the variable trust fund, again, in 2023, the variable trust fund achieved a 1-year performance of over 22%. And that was consistent with the very strong performance that we saw across equity markets. As a reminder, the variable trust fund is invested 100% in stocks, with 70% of that in the US, here domestic, and 30% of it international. As a result of its relative lack of diversification, because again, it's an all stock portfolio, and its concentration in an asset class with more risk, equity, the variable fund often generates higher returns, but also experiences substantially more volatility or ups and downs in its performance relative to the core trust fund. Now, the overall positive return in 2023, I think, really masked a much more interesting story in underlying equity markets for the year. You may have heard reference in the financial press to the Magnificent Seven, and those were the 7 top performing stocks in the S&P. So that was Amazon, Apple, Google, Microsoft, Meta, NVIDIA, and Tesla. And those 7 stocks drove the lion's share of returns for the S&P 500. So the S&P 500 was up 24% in 2023. And the lowest performer of those 7 stocks that I just named returned over 48%. And the highest performer, which was NVIDIA, returned almost 240% for the year. Now, the weight of those 7 stocks in the S&P 500 is at around 30%. And if you were to exclude the performance of those stocks, those 7, the rest of the S&P 500 would have returned just 8%. Now, what this means for investors is that your performance was impacted significantly by how much you had invested in these 7 companies. And again, like with the core trust fund, the slide you see here is showing how that variable trust fund has performed in the first quarter of the year. You can see, again, very strong absolute performance of close to 8.7%, and again, ahead of the policy benchmark, which returned about 8.4%. The next slide, please, Todd. Okay, thank you. Okay, so this is a slide that we show each year, and it compares 3 different portfolios. The first, which is the light blue line on the bottom of the graph, what that shows is the cumulative return that you would have received if you had invested $100 and a very simple, low-cost portfolio comprising 60% global equity and 40% investment-grade U.S. fixed income, and shows how that would have accumulated over the last 20 years. The second line, the yellow one, that shows what you would have experienced if you had invested $100 in our policy benchmark. And our policy benchmark has a richer set of assets than that low-cost 60/40 alternative. So it includes private markets and, again, a richer selection of both public fixed income and public equity than the simple 60/40 implementation. Finally, the top line, the dark blue line, that represents what you would have received if you'd put $100 into our actual investment portfolio and what you would have experienced over the last 20 years. And what's interesting to note from this slide is the value of having professional staff managing the WRS coming through in two distinct ways. First, our ability to implement a more complex and sophisticated asset allocation with investments in things like private equity, real estate, hedge funds, and venture capital. That has generated close to $15 billion over the last 20 years in terms of extra return over that simple passive 60/40 alternative. And that's, you can see on the graph, where the yellow line ends on the right of the graph versus the light blue line. So again, that gap represents $15 billion in value added. And then secondly, the second takeaway is that our ability to engage in active management, whether it's through our partnership with external partners or our internal investment selection activity, has generated returns above that passive portfolio. So the yellow line of another $13.5 billion over the last 20 years. And again, that's the gap between the yellow line and the dark blue line when you move to the far right. So again, a lot of value added over the last 20 years in dollar terms, in terms of the value that we've been able to provide to the retirement system here at the investment board. And then the last thing I'd like to note is that at least over the last 5 years, the core trust fund has actually experienced less risk or less up and downs than that 60/40 reference portfolio. And so that 60/40 cheap passive implementation has had a volatility of about 12% over the last 5 years. And the core trust fund has experienced a volatility of 11%. So a little bit less. And again, that comes in part due to the increased diversification that we have in the core trust fund asset allocation versus that simple alternative. And so now let's move on to our asset allocation. So we did make some changes at the end of 2023, and we reduced public equity target from 48% to 40%. We increased our allocation to fixed income, public fixed income, from 25% to 27%. We increased our target for private equity and debt from 15% to 18%. And we actually reduced our policy level leverage from 15% to 12%. And these changes reflect, in general, a weaker outlook for public equity relative to public fixed income, again, as fixed income yields have moved up meaningfully from where they were 2 or 3 years ago. The changes also reflect a continuation of our long-term plan to judiciously grow our private equity exposure over time. And then finally, the reduction in fund leverage reflects the reality of higher borrowing costs. So again, those higher interest rates that we're all keenly aware of mean that the cost of leverage has moved up. And so therefore, its attractiveness has been reduced, and we reduced our policy leverage as a consequence. Move to the next, please. Okay, thanks. So this is displays for you our actual asset allocation visually, as well as the expectations from our consultant in terms of the medium-term and long-term returns that we should expect from our current asset allocation. So you can see that over a 10-year period in the table on the right, this asset allocation is expected to return about 6.5%, but over the longer run, 7.4%, which again is in excess of our actuarial target. You can see the expected risk, which is expressed as standard deviation. And then finally, just to note at the bottom is that we do have, again, that ability to make investment selection, both, again, through our external partners and internally. And you can see that we have the ability to take a modest amount of risk in that dimension above and beyond what we're receiving from that policy allocation. And I'll pause here for just a second and hand over to Rochelle.
Thank you so much, Edwin. So if we go ahead to the next slide, I'm going to talk about cost effectiveness. So what Edwin was just speaking about is our asset allocation. And in some ways, that's really our diversification of the fund. Under our fiduciary duty, we have three main duties in connection with our requirements to manage the assets of the WRS. One is to manage them with the care, skill, and prudence of an expert investor, and only for the purpose of each fund. Two is to diversify the assets. And three is to manage those assets at a reasonable cost. So when we look at all three of those items, we're always looking at costs to make sure that we are managing our fiduciary duties. So I'm going to just take a couple of slides and briefly review how that cost looks. So you'll see on the left-hand side is our overall assets in 2023, which add up to about $150 billion. And you can see that 54% is with external management and 46% is managed internally here in Madison. We work with partners really around the globe to get the best mix of investment, whether that's internally here in Madison or externally around the globe, private equity, hedge funds, venture capital, and real estate to find expertise with feet on the ground through our external managers. On the right-hand side of this column is our overall cost for the year, which was $618.6 million. And you'll see that the vast majority of that does represent, the 77% of that does represent external cost-based fees to have those outside managers. And 23% represents what we spend here in Madison. Now, you might look at this and immediately draw a conclusion that we should just grow what we should do in-house because we can do it at a lot cheaper. And that is correct, that we can do it for less expensive and we can be prudent about that. But the opportunity set would be narrower if we only allowed ourselves to work here in Madison. And those third-party partners that we have, you're only looking at the cost part now, they actually bring substantial returns to the WRS. So when we look at this mix, we believe this is a prudent mix of managing the costs of the WRS to get the most value for our beneficiaries. If you move on to the next slide. One other way we determine how we're doing on costs is not just the mix itself, but we hire an independent cost consultant called CEM, and they're based out of Toronto. And they actually work with a number of pension plans across not just the United States. They work with 47 plans in the United States, public pension plans, but they also work globally in Canada, Australia, as well as European nations to look at costs and level set costs across the board. And so this dark blue area of this slide is our comparison against many items that they compare us to. So the first is the 47.5 bips. So that's 0.5%, or less than 0.5%. That represents our costs in 2022. This is actually always lagged 1 year behind. And so we look at that cost and we compare it against three different ways. The US peer median, those are 15 of the largest US public funds of those 49s that I talked about, to sort of see how we do against sort of the larger funds that look more like SWIM. And so that's exactly equal to where we had, where we came out at the 47.5. Then we look at a benchmark that CEM constructs for us, where they sort of take inputs from a lot of areas and say, okay, if you had what we assume is your asset allocation and the staff that you have, here's what we think that cost should be. And you'll see it's just slightly under where our cost came out. So we think we're doing pretty good against that benchmark. That 47.5 compares with the 46.6. And then finally, they compare us across the entire US population of those public pension plans, those 47 funds. And you can see there that they're more expensive than we are at the median. They are 54.3 bips comparative to our 47.5. So when we look at this comparison, we feel that this is a fair representation and tells us that we are meeting our fiduciary duty on cost. Now, the final thing before I give this up to Todd and just talk about the lighter blue on top of these that is listed as performance fees. Now, this is only performance fees of basically hedge funds is how they calculate it, as well as some of our external managers, not all of our external managers. So it doesn't include the external managers of all of these other types of comparison basis as well. But the important thing to note about performance fees is that you pay them when you receive the return. So this isolates just the cost, but when you're paying performance fees, it's generally a positive because that means for the year that you're paying them, you've received significantly more return and you're paying a share of that return with the manager. So in these cases, while they can be greater than our other peers, that's not a bad thing. It means we received returns in exchange for those fees. So we want to always keep track on this, and this is why we hire an independent consultant to help us out in that review. All right, Todd, I'll hand it back to you.
Okay, thanks so much, Rochelle, and good morning, everyone. Pleasure to be part of the call today. I'm going to be delivering SWIB's economic outlook. So let me begin with some key messages. I'm not going to read every word on the slide. I'll just try to flag a few key points here. The outlook is broken down into two different horizons, essentially what I would call a cyclical horizon, which is really the near term. It's kind of a business cycle movement, and then the long term. So let me start with the cyclical or near term outlook. Now, if you had asked me as an economist or looked at the survey of leading economic forecasters early last year, so in the first half of 2023, most economists were expecting a sharp slowdown in 2024 or even a recession. And we've had quite the opposite, as you know. We've had a very resilient US growth outlook with substantial disinflation, or that is a falling inflation rate. So this has really been a surprise to many economists and a good, happy surprise compared to what was expected earlier last year. So what's happening? Well, starting with the disinflation or the sharp fall in inflation rates, we've gone from an inflation rate that at one point hit 9% annualized to something in the neighborhood of 3.5% today. That is a very significant fall in inflation over a year or so, a couple of years. And historically, if you look at large disinflation, it's almost always been followed by a severe recession or at the minimum, a very significant soft patch in the economy. And so far, we haven't seen that. We've seen a very resilient US economy with this continuing pace of disinflation. Some economists have jokingly called this the immaculate disinflation because the miracle is that we seem to be achieving lower rates of inflation without a cost, where the economy remains very strong. Now, the US really stands out as something relatively unique in the global economy. Other economies have seen a more sluggish growth picture this year. I'll elaborate on that in a moment. So what's the story behind this disinflation? And I think an important part of that is as we emerged out of the pandemic, the multiple lockdowns here in the US and other countries around the world, global supply chains become very disruptive, everything from distribution, transportation. There was this big change in the composition of demand from services like restaurants and travel to goods that you could consume in the safety of your home. We saw two things happen. One, now we're well past the lockdowns. Global supply chains globally have begun to normalize. And at the same time, demand has shifted back towards services. People are going obviously back out, they're traveling, they're back in restaurants. So we've taken demand down for goods, and supply chains for delivering goods has also eased. All of these factors have allowed goods prices to lead the disinflation. So a big part of that fall in inflation rates we've seen is coming from the goods sector. Not so much in the service sector, and we'll get to that in a future slide. That's the remaining challenge going forward. What about the growth outlook? So the growth outlook has been one I would characterize for the US as resilient and strong. Right now, the consensus survey of leading forecasters expect US economic growth this year to be in the neighborhood of just under 2.5%, 2.4%. That's pretty remarkable. That compares to a long-term fully productive rate of growth of about 1.8%. So this is a very strong growth outlook, again, with continuing disinflation. So it's quite unique. But the forecast is also for strong average growth over the year, but slowing as we get towards the end of the year. And there's a couple of reasons for that. One is the continuing impact of high interest rates, so-called restrictive monetary policy impacting the economy. And the second is a running down of households' excess savings. So one really interesting phenomena that happened during the pandemic and the lockdowns is that households across the income distribution built up what economists have generally described as excess savings. And what that really means is they built up a cushion from stimulus checks and just from not being able to go out and spend. Savings surged relative to the baseline, building up a cushion that we could call excess savings. Now, what's nice about this excess savings is it's allowed households to smooth things out and allowed them to continue the consumer spending momentum that we've seen through 2022 and beyond. The problem with that is that those excess savings are getting drawn down steadily. And through the end of this year, a lot of those excess savings will be fully drawn down by most of the different groups in the income distribution. I'll talk more about that in a moment as well. Now, that's a pretty resilient, pretty robust outlook. I would say, importantly, there's also some important economic risk factors. There's always risks. Any given year, there's always going to be risks on the upside and the downside. But this year seems a little unusual in the sense that there's more risk than normal. Maybe it always feels like that, but I think trying to be objective, 2024 feels like a year of more risk than normal. And it would start with geopolitical risks. There's a lot of hotspots, a lot of flashpoints globally where potential conflicts or actual conflicts are in place. So starting with the war in Ukraine, with Russia's invasion there, it's created a great deal of uncertainty in Europe that's holding back investment and spending. It's led to higher energy prices and fueled higher interest rates in Europe to try to combat high inflation rates. All of that is likely to continue. And of course, the risk is that it escalates. The strategic rivalry, as I would call it, between the US and China is an ongoing concern and could also escalate on both sides. Both China and the US could escalate that rivalry with tariff escalations or other economic type of issues, which could, again, have an economic cost. And then, of course, the conflict in Gaza could spill over into a larger conflict in the Middle East, which could lead to higher energy prices. So there's many geopolitical flashpoints right now that could potentially, and this is why they're only risks at this point, but could spill over into a broader global economic impact. And then there's your old-fashioned banking sector risks. You know, the commercial banking sector, small and medium-sized banks in the US have a lot of exposure to commercial real estate. And as we all know, commercial real estate has been going through a rough period since the pandemic with lower occupancy rates, more people working from home now. Many commercial real estate loans look a little shaky, and small and medium-sized banks have an outsized allocation to that sector, to commercial real estate. At the same time, many of those banks have also purchased treasuries, which is the ultimate risk-free asset. But unfortunately, a lot of those banks bought them when interest rates were low and prices were high. We've seen just the reverse happen subsequently. Interest rates have risen very sharply, and that means bond prices have gone down, creating weakness in many banks' balance sheets. So that creates another exposure. So there's a number of risk factors out there to keep an eye on. And at this point, they remain risks, but things to keep an eye on. So let me pivot then to the long-term outlook. So as a pension plan, I would argue the long-term horizon is by far the most important horizon for us. Our mandate at the end of the day is to fund future pension benefits over generations to come. So when we think about our our asset allocation, when we think about how we invest, it's important to have a long-term investment horizon that matches with the long-term horizon of our liability, which is our pension payments, our benefit payments. So our plan, our objective, as it is for many pension plans, is to generate a sufficient rate of return on the portfolio to fully fund the system and balance downside risks to ensure that we don't exhaust the dividend liability, to ensure that we're not putting at risk higher contribution rates, but at the same time taking enough risk and achieving enough return over time to fully fund the plan. So this is our objective, and it's a very long-term objective. So what does the outlook look like over the long term? One way to think about that is to look at, you could think about them as risk return frontiers. So if I look at the low risk asset classes like cash, all the way to some of the higher risk asset classes, you want to see a steep curve so that you get rewarded for taking additional risk. And those curves have, over shorter periods of time, say over the next 5 to 10 years, have really flattened out as cash rates have surged. Meanwhile, valuations are getting a little less attractive in some other spaces. So the reward in the next 10 years for taking a lot of additional risk has flattened. But as a long-term investor, we look at 30 years and beyond, and those risk return frontiers still look attractive for taking risk and for achieving our long-run rates of return. So again, I'll come back to these ideas in future slides. But let's start with the cyclical outlook. And what you're seeing in this slide are the consensus forecast of leading economists and their forecast of growth in 2024. And the reason it's moving over time, you can see it starts in January 2023 and moves down. What you're seeing is in January 2023, what was the forecast for growth in 2024? And then as we move down the line, you're seeing how their forecast changes over time. So this goes back to what I was saying a moment ago. If you go back to early 2023, the outlook was getting more and more dismal. You can see that the red line is China, the green line is Europe, the blue line is the US. You can see that for all the major economies through the first half of 2023, the consensus survey expected a pretty sluggish growth outlook. The US growth outlook for 2024 got down to about 0.5%, which is borderline recession. Similarly for Europe and China, coming down. China is on the right-hand axis since its growth rate tends to be higher. Well, look what something remarkable happened, I would say, around the summer of 2023. The blue line, which again is representing the US economy, really started to change. You can see that it reached a low point, and economists began upgrading their forecasts quite sharply and quite consistently. And it continued to surge right into early 2024. What's happening here is a number of things. First, in the first half of 2023, economists for the US were expecting a slowdown because, again, historically, we've almost virtually always seen a very sluggish period of growth or even recessions following a disinflation because the Federal Reserve hikes interest rates to cool the rate of spending in the economy. That tends to cause more losses of jobs, job losses, unemployment rates go up, and that causes a recession. But we're not seeing that this time, as I mentioned earlier. And as time went on through 2023, we saw this immaculate disinflation. Inflation rates were coming down, while the economic activity data, things like consumer spending and growth rates, proved themselves to be very robust. So economists looking at the data coming in and looking at the falling inflation rates began to upgrade expectations of growth. And then the Federal Reserve hinted of interest rate cuts that were coming in 2024. Again, that led economists to believe we'd have a less restrictive interest rate environment, which would support economic growth rates in 2024. So the US really stood out globally as an economy that looked increasingly rosy, with economists now expecting about 2.4% growth for the year. Meanwhile, in the other major economies, China and Europe, that forecast hasn't really played out the same way. We saw a downgrading in growth and then it kind of flatlined. Economists haven't really expected growth rates to pick up in the same way as they have in the US. China has been beset by regulatory missteps, often politically motivated kinds of issues that have affected their markets, but also their investment. And very importantly, the property sector in China has been beset by oversupply and a lot of distress in terms of the debt that's been used to finance its property markets, which just recently led to some stimulus measures that the Chinese government announced, which might partially explain the uptick in the expected growth more recently. The Eurozone has also been downgraded in its growth and hasn't really seen a sharp pickup like the US either, because many of those factors continue to be in place. High energy prices, high interest rates, and of course the war in Ukraine, which continues to create a lot of investment uncertainty. Okay, let's turn to the inflation outlook. So this is a bit of a messy chart, but so let me walk you through this. You're looking at annualized monthly inflation rate. So every month we get a month-over-month inflation rate, and then we basically multiply it by 12 to get an annualized rate. So what that rate would look like on a full year basis. Now the red line, the darkest red line here, is a 6-month average rate. So the idea is to give a trend line. So what's the underlying trend in inflation like? And the other lines are a little bit more volatile because they're over shorter periods. There's a lot more noise in any given month. So the green line is 3-month average inflation, and the blue line is just month-over-month inflation. I should also note that this is core inflation, which strips out the most volatile components, food and energy. So what are we seeing here? Now, if you go back to 2021, 2022, the general trend line is down. This has been that remarkable disinflation or lower rates of inflation over time. But if I fast forward to more recent months, and I'm going to focus on the red line, which is the 6-month average of annualized inflation rates, look at the uptick. We've hit a bit of a plateau, and this has created a little bit more uncertainty in markets and amongst economists on whether we've hit a challenging spot where we've already disinflated because we captured the low-hanging fruit, and the next leg down in inflation to get to the 2% target could be a lot more challenging. Or it could be that we've just hit some noise in the first beginning of the year, and we'll start to see that tick down. So interestingly, if you look at the blue and green lines, you can see that they have turned over. So the most recent inflation reports have been quite positive. We're starting to see inflation tick down again. The red line, which is a longer average, 6-month average, is still on the upswing. So the Federal Reserve, which is thinking about incoming data and how to judge that incoming data when it's deciding on when to cut interest rates, I believe is going to want to see a more convincing, consistent picture of falling inflation rates before it pulls the trigger and starts dropping interest rates. So we need to see more of those monthly inflation rates start to continue that downward tick. The trick in order to achieve that, though, is that the disinflation has to move to the service sector. And that's all about the labor market. A big part of service costs come from wages, because wages are a big part of the cost of delivering services. You think about the restaurant sectors, travel, and so on. So getting wage growth under control consistently, more in line with productivity growth, was going to be the key to getting service inflation down. And we're at that tricky fork in the road right now to see if that handoff from the goods sector to the services sector will take place. Okay, so I mentioned that the US economy has been remarkably resilient and really stands out globally. And one of the key reasons for that has been that excess savings that came during the pandemic and during the lockdowns. So this chart was prepared by a senior researcher at SWIB. I love this chart. I think it's a brilliant chart that really shows how by different income categories in the income distribution, you can see how that excess savings has behaved. So let me walk you through this. What you're seeing is deposits and money market funds as a percentage of spending. So it kind of gives you a sense of how much liquid cash or assets do households have that they could quickly turn into spending. And it's broken down, these lines represent different buckets in the income distribution. So the 99 to 100 percentile is basically the top 1% of the income distribution. So you can see basically savings as a percent of personal spending evolve over time. And look during the pandemic. Across the income distribution for different households in the income distribution, you can see that strong uptick. This is the excess savings from trend. But look at what's happened since that time. So in the top 80 to 99th percent of the income distribution, we've seen a very steady drawdown in those savings, which has helped support the strong pace of consumer spending in the economy. We're seeing that in the lower income distributions as well. After a strong peak, households have been drawing down those savings, which has supported strong consumer spending. The one category that really bucks the trend are the 1%ers, the top 1% of the income distribution, which is represented by this dark line. You can see, most likely because they have very strong income and other sources of wealth, have not needed to draw down on those excess savings. So they jumped during the pandemic and have stayed constant. Now, for the overall consumer spending in the US economy, you can see for most households, those excess savings are getting drawn down. And it's one of the reasons I think why economists are expecting the pace of growth in the US economy to start moderating, to start falling, not into dangerous territory, but just to fall from these very strong levels that we're currently experiencing and slowing to something more like 2% by the end of the year. Okay, let's switch gears now to the long term. And I mentioned our investment horizon is very long term. That's important, again, because the portfolio that SWIB manages for the Wisconsin retirement system is to fund future pension benefits. That's our liability that these assets are funding. So our horizon on the investment side, on the asset side, has to be long to match the horizon of our liabilities. So what you're seeing in these two charts is the top chart, you're looking at the expected returns for different asset classes, cash, the 10-year treasury, US large cap stocks, and private equity. And these are the expected returns by SWIB's asset allocation consultant, NEPC. So what you're seeing are different time horizons and different time periods. So the top chart is their forecast for returns over 10 years. The bottom is their forecast for returns over 30 years, the long term. So I'm going to start with the top one and then we'll go down to the bottom one. Now, I really like these charts because what they show is how the expected returns have changed in 2021, which is the blue line. The green line was 2022, and the red line was the end of 2023. And you can see that the lines are getting much flatter. And what that means, the blue line back in 2021, which was a brilliant year for investing, cash returns hadn't increased that much. And bonds and stocks, private equity offered very attractive premiums over cash and over lower risk assets. It was a steep curve. But by 2022 and 2023, cash rates had surged. And that reflected the fact that the Federal Reserve raised interest rates very sharply to fight inflation. Suddenly, the risk return frontier flattened out a lot. So this looks like an unattractive picture until you look at the long horizon. The long horizon, which is a 30-year expected return, which is better matched to our horizon as an investment organization, you can see that the curve has flattened out compared to 2021. Remember, 2021 is this blue line. You can see that 2022 and 2023, there has been some modest flattening, but over the very long term, higher risk asset classes continue to provide a premium over the lower risk asset classes, which I think is an important takeaway for a long-term investor such as SWIB. So what are some of the drivers of the short term? Well, there's concerns about valuations, for example, in the marketplace. I think all of us have heard about the so-called Magnificent Seven stocks. I think Edwin mentioned them earlier. These Magnificent Seven stocks 7 stocks, and out of the top 500 stocks, they now represent about 30% of the total market value of those 500 top large cap stocks. It's really quite extraordinary. So there's good questions about the sustainability of that rally. So these valuations have changed the attractiveness in the short run. And I'm going to end on this slide in terms of the long-term outlook. So this slide is about government debt and deficits here in the US, but also other major economies. We all know that during the pandemic, government spending in terms of transfers and support to households that were through no fault of their own, affected by the pandemic, by lockdowns, many people lost their jobs. So there was a surge in deficits and debt to help smooth out the business cycle and smooth out labor income. And you can see that in this chart where you look at total debt as a share of the economy, as a share of GDP in percent. And you can see for most major economies, there was a big surge during the pandemic. But what's really extraordinary is we have these boom times in the economy. Growth is very strong. The unemployment rate is near multi-decades low. And look at projected debt for the US economy in the blue line, continuing the surge. It's now projected to increase well beyond 100% of GDP. Similarly, in China, another large important economy for global growth, it's a very high debt economy, especially for its level of economic development, and it's also expected to continue surging. Only Europe is really expected to stay relatively stable in terms of its debt ratios. This is a very concerning state of affairs because economists and policy wonks like myself from a former life like to point out that, hey, we have a lot of age-related spending coming over the next 30 years, and that could put a lot of pressure on government spending, everything from healthcare-related spending, pension-related spending for public pensions and old age support. These kinds of things put a lot of pressure on public finances over time, and we're already starting from a very highly indebted point of view, a very highly indebted level. Another concern is deficits, the rate of sort of the imbalance between revenues and spending in any given year. In the US economy is now projected to be over 6% of GDP over the coming years, which is a remarkably high deficit at this stage of strong economic growth. And it really bucks the historical trend where deficits tend to be lower in the good times, and then deficits get bigger in the bad times. What that's doing is leaving us less fiscal space to deal with shocks, with future surprises or downturns. So I think this is an important policy issue. It's an important issue for long-term investors as well, to keep an eye on what this could mean for risk premiums in fixed income markets. So I'm going to stop there. Hope I didn't go too long or be too dry, as economists often are accused. So hopefully that wasn't too bad. I'm going to pause there and maybe pass it back to Rochelle.
Thanks so much, Todd. We go ahead to the next slide. I'm going to just talk a little bit about some updates both with staff as well as trustees, and give some information about some upcoming events here at SWIB. So we had a couple of changes in 2024 to our Board of Trustees. Governor Evers appointed Clyde Tinnen as our board chair and Tom Merrifield as our vice chair. Clyde is a corporate partner at the Milwaukee law firm of Foley and Lardner. And Tom Merrifield is the former chief financial officer and chief risk officer of now TruStage, but formerly CUNA Mutual. So real excited to have that new leadership that was in transition, with Barb Nick stepping down as board chair after 8 years of service to our board. In connection with that vacancy, Governor Evers appointed Barb Bolins to the board. She is the director of the Nicholas Center for Corporate Finance and Investment Banking at the UW here at Madison. And then also before the end of the session in 2024, the legislative session, all outstanding trustees were confirmed by the Senate. So we have a full house of our Board of Trustees and a couple of new faces, and we're very excited about this leadership. As a reminder, our Board of Trustees is an independent Board of Trustees whose goal is to manage and oversight the WRS. If you can flip to the next page. Just want to talk a little bit about how our staff both is recognized globally and shares our expertise, as well as gaining best practices and exchanging knowledge and information really across the globe. So Edwin was recently named to the board of directors for the International Center of Pension Management, which is a group of invited pension plans across the globe that are well renowned in the industry. Anne-Marie Fink, who is our Private Markets Alpha CIO, our Chief Investment Officer. This is our private markets side of the house. She was recently named as the co-chair of the Alternative Investment Management Association's Global Investor Board. So thinking about private equity around the globe. Derek Drummond, who is our head of Funds Alpha. Our Funds Alpha team is really a combination of our external manager and hedge funds, and he runs that portfolio. He was recently named to the Standards for Investment Alternative Investments Board. And then finally, you see that Chris Eckerman, a senior portfolio on our private equities team, was recently named to the slate of directors for the Institutional Limited Partner Association. And this is a group of anytime you're invested in a private equity fund, the investors are called LPs or limited partners. And so this is a trade group that really represents the interests of limited partners in connection with our private equity investments. We can move on. So I want to talk a little bit as a reminder, what we do on every few months is we put out a podcast, very short, easy to consume in your car or quickly as you're taking a walk. And the idea is to give you a better insight into what we do at SWIB, whether it's our strategies. You can see our recent last ones were related to the housing market and our mortgage-backed securities portfolio. We just did one to give it a bit more in depth on how our co-investment portfolio works, which is a direct investment arm of our private equity portfolio. And then we get Edwin to arrive at least twice a year to talk about his end of the year view and his beginning of the year outlook. So we put these out to make sure that people have you have a chance to sort of hear from us directly about what we do. And we have found that our participants in the plan and other stakeholders have enjoyed learning more about SWIB. I want to go to the next slide. And I want to invite everybody on this call to our investment forum. It is a virtual format, just like today. You can go to our website, www.swib.state.wi.us, and go to our investment forum page to be able to sign up. It's 2 virtual sessions on the afternoons of Tuesday, June 11th and Wednesday, June 12th, from 1:30 to 4:30 each day. And what we work to do is to get a panel of distinguished speakers to come and talk about important topics that are affecting the investment outlook as well as the market. So we have speakers on commercial real estate, AI, the energy transition, the effect of drugs like Ozempic and Wegovy on healthcare and other investment opportunities. And we also have someone coming to talk about, we always have a behavioral economist who talks about influences of the market and how they're driven by sort of the human nature. So these are always fantastic sessions. I encourage you can listen to one or all, and you can do so from the convenience of your home. And then finally, on the last slide, we like to say all the different ways that you can reach out to us throughout the year, not just when we're here presenting to you, but we're always happy to answer questions. And just as I noted on the podcast, really just going to our website will provide you a lot of information about SWIB. Our job is to make sure that information is accessible.
And thank you, Edwin and Rochelle and Todd, for being here this morning. Very stimulating conversation, and we really appreciate your presentation. All right, so our next speaker is Mr. Douglas Poland from Stafford Rosenbaum LLP law firm. Doug's practice focuses on appellate law and complex litigation with emphasis on business, contract, and real estate disputes, election and voting rights law, environmental toxic torts, products liability, and consumer fraud lawsuits. Doug has decades of significant experience in complex litigation matters in state and federal courts in Wisconsin, Illinois, and throughout the United States. He will speak today on the issue of gerrymandering in Wisconsin. Welcome, Doug.
Thanks very much, Diane. I guess as they used to say on Monty Python, and now for something completely different. This is a very different topic. I am going to talk today, as Diane said, about gerrymandering, and I've actually been in front of you before talking about this several years ago. So some of this might be familiar to some of you, but there have been some significant developments over the last several years, and so there's quite a bit of new information as well that I hope that you find helpful. I'm going to share my screen here. And hopefully everybody will be able to see this. If you can't see it, someone should let me know, but I'm going to jump right in. Let's talk about redistricting, because that really is the context in which we find gerrymandering claims being brought. So we redistrict or change our districts in which we elect officials at the federal level, at the state level, and at the local level. And we do that every 10 years. Why do we do it? Well, it's because we take a census every 10 years. The last one was in 2020, as you probably all know. And the one before that was in 2010 and going on back. And this is important because in the 1960s, the United States Supreme Court decided a number of cases in which it held that we need to have population equality in our districts. There is a one person, one vote rule, and the districts have to be equal in population. If they're not, as you can imagine, you could draw two districts. One would have one voter in it, and one would have 1 million voters in it. And if they were electing the same, each of them got to elect a member to a representative body, that would not be equality, at least in terms of voting power. And so the U.S. Supreme Court did decide that we need to have population equality in our districts. This standard of population equality applies to our congressional districts. We have 8 of them in Wisconsin. And so we do have to have perfect population equality down to the person. They've got to be the same population. This rule applies to our state legislative districts. That's our state Senate and our state assembly in Wisconsin. There's a little bit more leeway that's given for population equality in our state legislative districts. Up to 10% has been accepted, but with the power that we have, the computing power and the data that we have now, we can really make that difference, that delta between the most populated and the least populated districts. We can keep it to about 1% now, so that we have really quite close population equality. But it also applies to our local government districts, and so the population equality that we need requires our municipal districts, like our aldermanic districts, or alder districts as we call them in Madison, to be equal in population too. So we redistrict every 10 years, and it's to rebalance the districts, right? People are born, people die, people move into districts, they move out of districts, they move within districts, and they do that over the course of 10 years, so that our districts become unbalanced and we have to rebalance them, or redistrict as we call it. So what's required when we're drawing state legislative districts in Wisconsin? I'm going to focus on the state legislative districts, because really these are the districts that that have been most in the news, and they really are most impactful when it comes down to making law in Wisconsin. We do have strict legal requirements that we get from both the United States Supreme Court, as I identified before, roughly equal population. That's a determination that was made by the state Supreme Court. It's now incorporated in our state law as well. But we also have requirements that appear in our state constitution and in our state statutes. So our state legislative districts must be contiguous, and that's been interpreted by our state Supreme Court to mean they've got to have a territory that's actually all touching. You can't have a district that has islands, in other words, that are sort of discontinuous territory that's floating around in the middle of another district. So all land, all of the land within one district has to actually be physically touching. The districts must be as compact as practicable. That's a constitutional requirement. And the term as practicable is one that doesn't have a strict definition, but we look at plans, typically we're comparing them. There are a couple of different tests that political scientists use to measure compactness. And again, that's not a very difficult thing to do, to meet, and to satisfy when we're drawing our maps with the very powerful computer programs and the data that we have now. So that really hasn't been too much of an issue as we've litigated it. Another constitutional requirement, state constitutional requirement, is that our districts must preserve or keep political units, meaning wards, municipalities, and counties, intact when possible. Another way of stating that is that the district lines need to follow either ward lines, municipal lines, or county lines when they can possibly do that. Again, that's not a difficult thing to do. At the very least, they can follow ward lines. So that's something that's typically met quite easily. There are a couple of other overlays as well. We do have the Voting Rights Act of 1965, which is a federal statute. It was passed in 1965. It was reauthorized many different times over the years. It still is in effect. And in particular, Section 2 of the Voting Rights Act, which deals with ensuring that we are drawing, or that legislatures are drawing the district lines so that they don't disadvantage or dilute the votes of minorities, racial minorities. That's an important statute that also has to be complied with when we're drawing legislative districts. And then there are other federal constitutional requirements that have to be complied with as well. We'll talk a little bit more about some of those in a little while. There are other what we call traditional redistricting criteria. These are not criteria that are set necessarily by law. It's not by constitution or by statute, but these are things that are, from a normative standpoint, we try to satisfy. One of them is preserving communities of interest. The idea is that people who have common concerns should be able to be represented in a legislature or another representative body by just a single representative who can voice all of their concerns. And so that's what we call a community of interest. A community could be of interest could be defined geographically. It could be defined by race or ethnicity, or it could be defined by some other kind of interest. But it is a community of interest, and so we try to preserve those. And we'll get into this in a little bit more detail as well. Partisan fairness. This featured very prominently in litigation we've had in Wisconsin in the state Supreme Court over the past years. But actually, if we go back even several decades and we look at the decisions of federal courts in Wisconsin on redistricting issues, they have always stressed the need for partisan fairness in the districts that are adopted. So that's just a general overview of the kind of criteria that we have when we look at redistricting. So now let's jump into gerrymandering a little bit more and talk about partisan gerrymandering. There are various different kinds of gerrymandering, including racial gerrymandering, but I'm really going to focus on partisan gerrymandering here. What is partisan gerrymandering? Well, it goes back a very long time in the United States. It goes back actually to an election in Massachusetts in 1812. The governor at the time was Elbridge Gerry, and it is pronounced with a hard G. And so even to this day, some of the real hardcore gerrymandering experts who want to emphasize the historical tie will say gerrymandering as opposed to gerrymandering, but I think most of us say gerrymandering. But it was Elbridge Gerry, and there was a district that was drawn while Elbridge Gerry was the governor of Massachusetts, and the comment was that it looked like in a newspaper at the time that it looked like a salamander. So you have Elbridge Gerry, and you put the Gerry together with salamander, and you get gerrymander or gerrymander. That's the origin of the term. But essentially, partisan gerrymandering is the deliberate drawing of district lines to gain a systematic advantage for one political party over another. You're gaming a system of drawing lines so your political party will have an electoral advantage. That's really the essence of partisan gerrymandering. And the ways that a partisan gerrymander is effectuated is through two techniques that are called packing and cracking. These are terms that you might have heard before. Give you a little overview here of how we pack and crack. Let's say we have a total of 50 precincts or districts or whatever the representative body, the different areas are called from which we're electing representatives. Let's say we have 50. Let's say 40% of them are for the Teal Party or are populated by voters who tend to favor the Teal Party, and 60% of them are populated by voters who tend to favor the Blue Party. In any if you had direct representation, the blue party obviously would win, and it would win by a landslide. And you'd have a vast majority of that body that would be made up of the candidate or the candidates who are preferred by the blue party. They'd have control. But there's a way through packing and cracking that the teal party could actually win the majority of districts. So first of all, let's talk about packing. Packing simply means that you're going to, if you're drawing district lines, you are going to put more voters into a district than is necessary to elect a candidate of that particular party's choosing. So let's, in this example that we've got here, what we're going to do if we're the teal party and we're trying to gerrymander, we're trying to win this district where we have a significant disadvantage, is we're going to draw the districts, so we're going to pack more blue party voters into 2 of the districts, right? We're going to put, if it only takes 50.1% of the voters in a district to elect a candidate of their choosing, we're going to put 75 or 80% of that district populated by the voters for that party. So we're going to pack them in there. That's going to have the impact of wasting a tremendous number of votes, or air quotes around wasting, because there are far more voters for the blue party than are necessary to elect the blue party's candidate in those 2 districts. That's packing. Cracking is the opposite. Cracking is when we draw districts. So again, if I'm the teal party and I'm drawing these, I want to draw those districts so they include voters for my party in a very efficient way. Just enough voters for my party, the teal party, that we are going to win that district. And so we're going to waste as many of the blue party's voters as possible, and we're going to make sure that we win that district. Usually don't cut it at 50.1%, maybe you draw it so it's 52% or 53% or 54%. But again, the idea is a really efficient distribution of your party's votes. And so if you do that through packing and cracking, if you're the teal party, you can actually come out ahead and you can win the majority of the seats in and control in that particular representative body. Let me show you some real world examples of how this played out in Wisconsin. And so you're looking here at a screen or a slide that has maps on the left-hand side and on the right-hand side. And so if you look in the upper left-hand corner where it says composite current map, those district lines there are the district lines in the Milwaukee area for state assembly districts that were drawn in 2002 by a federal court in Milwaukee. And if we take those 2002 district lines, and if we now fill them with the voters, the population as it was taken in the 2010 census. So we're going back here 10 years. This is a slightly older example of packing and cracking. If we, if when the redistricting had occurred in 2011, if we had just kept the district lines intact from 2002, and we populated those districts with the 2010 census data, you would have seen that of those 8 districts, state assembly districts around 2, 4, 6, 8, those 8 assembly districts around Milwaukee, 4 of them would have been Republican or tilted Republican, and 4 of them would have tilted Democratic, meaning that we probably would have elected those from those districts. They would have been basically roughly split. 4 of them would have sent Republicans to the state assembly, 4 of them would have sent Democrats to the state assembly. But what happened in 2011 was the Republicans had gained control. They had won the state assembly and the Senate control of those in the 2010 election, and Governor Walker was the governor. And so in 2011, they adopted new districts, and this was 2011 Wisconsin Act 43. And so on the upper right-hand corner where it says composite final map, what you're seeing there is the districts the way that they were actually drawn by the Republican majority in the legislature and signed into law by Governor Walker. And so what you can see there is those districts were drawn so that those 14, 13, 15, and 84, those districts that are numbered, as you see, they come over and they reach into those blue districts just north of Milwaukee, and they pull those voters out into overwhelmingly red districts. In other words, that's an example of cracking. They're pulling Democratic voters out of those districts in Milwaukee that you see under the composite current map. They're pulling them into majority Republican districts where their votes are basically diluted, they're being cracked. And so the net effect of that is that by redrawing the districts in that way, the Republican Party was able to gain 2 additional seats in the assembly. So instead of a 4-4 split, you now have 6 Republican districts and 2 Democratic districts. Along the bottom of that slide, you'll see the same thing happening in Racine and Kenosha counties. Again, bottom left-hand corner, those are the districts as they were drawn by a federal court in 2002. Those are populated with the 2010 census data. And over in the lower right-hand corner, that's the way that the Republican majority in the legislature actually drew those districts. Again, they ran the districts in Racine and Kenosha over into those the blue districts in the city of Racine and the city of Kenosha. They pulled many of those voters out into the overwhelmingly red majority districts, and so they cracked those blue voters. You can also see that the blue districts, especially up in Racine, became much bluer. They also did in Kenosha as well. That's the packing part of it. So more of the Democratic voters got packed into districts 64 and 65 in Racine and Kenosha, and then other voters got cracked. So those are real world examples of packing and cracking. So that was, as I mentioned, that was 2011 Wisconsin Act 43 that accomplished that. The Republicans again had won control over the of the Assembly and the Senate in the midterm elections in 2010. And because it was a decennial census year in 2010, we redistricted in 2011. And so it was the Republican Party that got to the majority in the legislature that got to pass those maps, and Governor Walker signed them into law. It all happened very quickly in a period of time that ended in July 13th. July 19th and 20th of 2011, when the legislature passed those maps and Governor Walker signed them into law. So, as often happens, or is now sort of the norm, these maps were challenged in court. I was part of a group that challenged these maps in the federal court in Milwaukee. And this case was called Baldus versus Government Accountability Board. The Government Accountability Board part of this is that was the state agency at the time. It was a precursor or predecessor to the Wisconsin Elections Commission. It was in charge of administering the laws, and that's why we sued the Government Accountability Board. Not that they did anything wrong; it's simply that they were the agency that would be actually administering the laws. So we challenged the districts in 2011 for a variety of different legal theories, and we received a decision from the federal court in March of 2012. And one of the theories that we had sued under was Section 2 of the Voting Rights Act. I had mentioned that in an earlier slide. The Voting Rights Act is one of those tools that we can use to challenge districts as unfairly diluting the votes or denying the votes of racial minorities when those districts are created. And so we did win a change of districts 8 and 9 that were in the center of the city of Milwaukee. There were some lines that were adjusted there, but largely the districts stayed the same. So we had a total of 10 claims, and the other ones we lost. One of the claims, we'll talk about this a little bit more, was a partisan gerrymandering claim. We brought that claim, but we ended up not prevailing on that claim. So with those relatively minor changes to districts 8 and 9, otherwise Act 43 remained intact, and so that became the law beginning in about April of 2012. Now, there were a number of people who were not satisfied with the outcome of the case in Baldus. I was one of them, and there were many others as well. There was a group from Milwaukee that included Fred Kessler, who was a representative in the assembly at the time, Bill Whitford, who was a law professor at the University of Wisconsin, Sachin Cheda, who is a political consultant in Milwaukee, and there were a few other people. And they got together and they decided that they wanted to mount a second court challenge, and they started looking for people who would help them to file that challenge and to come up with a theory to be able to challenge these districts specifically as a partisan gerrymander. And the lawyers that they found to help them ended up being, there's a law professor at the University of Chicago named Nick Stephanopoulos, who had just written an article with a political scientist, Eric McGee from California. And the article that they had written was on a metric that they called the efficiency gap. We didn't have a way before they came up with this article of really measuring in a scientific or mathematical way what constituted a partisan gerrymander. And so they came up with this theory that revolved around the concept of wasted votes that I mentioned before. The idea being that what a partisan gerrymander does and how you can recognize it is really if it wastes a lot of the votes of one party over another. And so based on that theory, this case, Whitford versus Gill, specifically a partisan gerrymandering case, was filed in the federal court here in Madison in 2015. So the theory, or the legal theory that it was based on, was a violation of constitutional rights, the First and the 14th Amendment. And so it drew on a lot of law that we had that existed in other contexts before the time they filed the case. And what was really important about this challenge is that partisan gerrymandering claims had been brought before. They'd been brought for several decades, stretching back in the 1960s. People had tried to win partisan gerrymandering claims. And throughout that time, we have 9 justices on the United States Supreme Court, and throughout that time, it was fairly consistent that 4 of the justices, typically, what we refer to as the liberal justices, were in favor of recognizing partisan gerrymandering claims as being claims that could be brought under the federal Constitution. And there were also 4 justices on the United States Supreme Court who historically had said, no, you cannot bring partisan gerrymandering claims. Those claims present purely political questions that courts cannot adjudicate. And so 4-4 would be a tie. There was one justice who had been in the middle, and that was Justice Anthony Kennedy. And Justice Kennedy had said, well, I think there could be a constitutional claim for partisan gerrymandering as violating the Constitution. But what we need to find is a workable standard. In other words, how can we tell when districts that are drawn actually constitute a partisan gerrymander? We know it is a political question in the first instance because the responsibility lies with the state legislature to actually draw the districts. That's a political function. And so we have to give the legislature some leeway. But at some point in time, things that the legislature does can violate the constitutional rights of voters. And so the question was for Justice Kennedy, where is that line? How do we draw that line? How do we decide when the drawing of districts that advantage one political party over another, as they almost always will, there's almost no way of getting perfect political neutrality. But how does that become so bad that it's a partisan gerrymander that could violate constitutional rights of voters? That's what Justice Kennedy had been looking for a couple of decades. What is a workable test that courts can employ and that legislatures can understand when they're going through this process is a line that they can't cross. That's really what the Whitford case was about and what we tried to do. And so we came up with what we call a standard, and that, again, based on existing law from other contexts, where we said we should have to show that the legislature in drawing districts acted with a partisan intent, that it actually succeeded, that there was a partisan effect of that unfairly diluted the votes of voters of one of the political parties, and also that there was no neutral justification that the legislature could show for drawing the districts in the way that it did. So that was the test that we proposed when we brought the case. So the first prong, partisan intent. And what I'm going to show you now is what we showed the court, the federal court here in 2016, when we tried the case in Madison to a panel of 3 federal court judges. And so what you're seeing in front of you is a map of Wisconsin. Again, these were the districts as they were drawn in 2002 by the federal court, and these are populated with the 2010 census data. And so what we were showing the federal court with this slide is that if the legislature simply took the 2002 districts, right, didn't change a thing, and we populated those districts with the 2010 census data, what would happen is that there would be 50 districts with a Republican vote share over 50%. And we've got a 99-seat state assembly, right? And so if the Republicans, by not changing any lines whatsoever, they would have had a 50-49 advantage, right? And all of these slides that I'm going to show you now, all of the data were taken from computers that we obtained from the state legislature when we were taking discovery in the Baldus case, right? So that was the one back in 2011, 2012. We actually got the computers, we got the federal court to order the legislature to give us the computers that were used to draw the district lines back then. And so we were able to take all that data and use it in this case, right? So these are all slides taken from the computers of the Republican aides in the Senate and Assembly who actually drew the districts in 2011, right? So this is our starting point. 50, if the legislature does nothing other than just keep the lines exactly as they were, they're going to get 50 of the 99 seats. So they're going to have a 1-seat majority in the Assembly. So this is the next slide that we showed to, or next map that we showed to the federal court in 2016. It says Handrick map 11. That's because these data came from a computer that was used by a consultant named Joe Handrick, who was working with Republican aides who drew the maps. This comes right off his computer. And what this shows is that on the Handrick computer, there is a map that was drawn where they were able to actually tweak the lines so that you got a Republican seat share that got up to 53, right? So the idea is that we can tell, because we have the computing power now and we have all of the data from past elections, we can go into these different districts that we're drawing, and we can essentially project what the likely partisan impact is going to be, or outcome of those districts. I'm not going to say predict, because we don't know who's actually going to turn out, but it's a common practice now. It's actually built into the redistricting software that's available and that everybody uses, that when you draw lines, when you draw new districts and you populate those districts with the census data, one of the metrics that you'll see, in addition to compactness scores and population deviation, is you'll see the likely partisan makeup of the districts and what it's going to be. We can know, right? It's not like this is some kind of magic or soothsaying or reading tea leaves. We know to a pretty good degree of scientific certainty how those districts are going to be composed from a partisan standpoint, right? So Joe Handrick on his computer was able to tweak the district lines and come up with an overall plan for Wisconsin that would give 53 of the 99 seats to Republicans. But they weren't done there. This is Handrick map number 9. Tweak the lines a little bit more and you can get 54 seats. This comes from one of the aides, Adam Foltz. This is a map that he drew, and he was able to get 56 seats that had that would likely be won by Republicans out of the 99. Tad Ottman was another one of the aides. He was able to draw a map that would give Republicans 57 of the districts, and on and on and on. And what ended up happening was they maxed out at 59. This is a chart that we actually drew in the courtroom for the court. As you go along the x-axis, that is in time as they're drawing more and more districts, and the y-axis is the number of seats in the assembly that their proposed plans predicted they'd win. So you can see they basically flatlined at 59 seats. So that's what they ended up adopting as a map. The final map projected that they were going to win 59 seats. They actually did one better than that even in the election with the districts they were able to draw. So we convincingly proved to the court's satisfaction that we satisfied that intent test. There was an intent there that they had to advantage Republicans overall in the assembly. So the second prong that we said we would have to show would be effect, partisan effect. They actually succeeded in what they were seeking to do. And so this, again, this concept revolves around the idea of the efficiency gap. This is the measurement, the relative measurement of wasted votes. Which political party's voters are going to have more votes wasted? That's the efficiency gap. And then in addition to just the magnitude of the advantage that one political party would have over the other question is durability. How long is this advantage going to last? Is this advantage designed to last throughout an entire decade until we redistrict again, or is it something that's going to have a very short term? Those were two things that we were seeking to show. This slide, you probably can't see anything on this slide other than that there is a line, a horizontal line, right down, I'm sorry, a vertical line right down the middle of the screen, a dark line. Everything on the right of that line shows an efficiency gap that favors Democrats. Everything on the left side of that line shows state legislative district plans that favor Republicans. One of our experts we commissioned to do a study of all of the legislative district plans from every state in the United States between 1972 and 2014, and to measure the efficiency gap in every single one of those plans. So all the plans to the right of that vertical line are pro-Democrat plans or pro-Democratic Party plans. Everything on the left of that line are pro-Republican Party plans. And so you can see, it's often said that both Republicans and Democrats will partisan gerrymander when they can, and in fact, they certainly have. But what this shows you is you can see a circled line in the lower left-hand corner. It says Wisconsin Act 43. What that shows you is that Act 43, that was the fourth most extreme partisan gerrymander of any plan in the United States between 1972 and 2014. Right. So we showed that this was, it wasn't just an intent to actually give us a significant advantage to Republicans. They actually succeeded. The fourth most extreme partisan gerrymander in the United States in the 70s, the 80s, the 90s, and then the first half of in the 2000s as well, first half of the 2010s. In other words, in addition, the idea of partisan symmetry comes into play as well. The idea of what we want to get from a normative standpoint is symmetry. We want the districts to be symmetrical. What that means is that if you draw districts in a certain way, we want those districts to be competitive. And so we want them to be not so tilted that the outcome is really, preordained. And so we do that by looking at whether the district has a equal opportunity of being won by Democratic candidates or Republican candidates. And we really are talking two-party voting system here, so we're not really accounting for third parties. So we're looking at partisan symmetry. And from a partisan symmetry standpoint, what we see is that Act 43 is actually, it shows extreme asymmetry. The slide that you're looking at comes from a website called Plan Score, and this shows as a distribution the efficiency gap. Balanced plan is again sort of in the middle of the distribution there. A pro-Democratic plan would be to the left of that. Pro-Republican plan would be to the right. And what this slide shows is that the efficiency gap is a plus 12% pro-Republican efficiency gap. That's an extremely biased plan toward Republicans. It's an asymmetrical plan. Again, this is something that we showed to the court. This is a slide that also will show you the asymmetry inherent in Act 43. This actually, the chart, the numbers that you see in front of you come from a footnote in the federal court's opinion. And what this shows is this is what Act 43 was designed to do. So all these numbers actually come right from the computers of the people who drew the plan. And if you look at the percentage of vote received for Democrats, which is down the left-hand column, and right next to it is the corresponding column of seats that Democrats would be predicted to win if they received that vote share statewide. As you can see, again, this is the designers and the drawers of the districts in 2011. They designed it so regardless of whether Democrats won statewide in Wisconsin, 47% of the vote, 48% of the vote, all the way up to 53% of the vote, they were always going to win a minority of seats in the assembly, right? Democrats have to get to 54% of the vote received statewide before they actually get a majority. If you go over to the right-hand side of the slide, you'll see the exact opposite is true for the Republican Party. The Republican Party just needs to win. If they get 47% of the votes, they're going to win a majority of the seats in the state assembly. And so regardless of what happens, if they get 47% all the way through 54%, they're always going to have a majority of seats in the assembly. And as far as durability is concerned, are they going to be able to hold on to the advantage throughout the entire decade? This just shows you what happened. Actually, in Wisconsin, these are actually the vote shares that Democrats and Republicans won statewide between 2012 and 2018, and the seat share. So again, you can see Democrats can win as little as 45% of the vote share statewide, like they did in 2016. They can win as much as almost 53%, like they did in 2018, and they're going to get no more than 39% of the seats, which is basically 39 seats. That's what they got in 2012. And the flip side of that is the Republicans, they drew the districts in a way that even in 2018, when they win less than 45% of the votes statewide for assembly, they get 63 seats, almost a supermajority in the assembly. So we clearly proved, and the court found, that there was a partisan effect. The third part of the prong was no neutral justification, and here the Government Accountability Board, or at the time it was the Elections Commission, tried to prove that there was a neutral explanation or justification for the way they drew the plans. They said it's because of the way that Democratic and Republican voters are dispersed throughout the state. They said that that because Democratic voters naturally pack themselves into cities like Milwaukee and Madison, whereas Republican voters tend to be dispersed throughout the entire state, that explains the magnitude of the difference in the efficiency gap. We had a few different things that we showed to the court. This is one of the pieces of evidence that we showed to the court, and that is these were simulations that were run by an expert named Joey Chen. There were 200 computer simulated districting plans that he drew, and the red ones that you'll see that are over in this scatter plot, pretty much concentrated in the same area. Those are ones that are controlling for partisanship. So if you are taking partisanship into account and you're drawing plans, that's what you get. I'm sorry, if you're not taking partisanship into account, that's what you get. Act 43 in the lower left-hand corner is an extreme outlier. And so, we were able to show that this idea that that voters locating themselves in certain areas drives the outcome and accounts for that tilt simply isn't true statistically. So we won the case in the district court. We then went up to the U.S. Supreme Court in 2017. We received a ruling in June of 2018. The court actually ruled, didn't address the merits, didn't take away our victory in the sense that it didn't say that the district court was wrong. But what the U.S. Supreme Court said is that plaintiffs didn't prove that they had standing to sue. They didn't have, it's a very technical legal concept, that they didn't have a constitutional injury, that we didn't prove it. And so they said, we're going to send you back down to the district court for a new trial in July of 2019, and you can try again to show that your plaintiffs suffered a constitutional injury, that they have standing. In the meantime, however, the U.S. Supreme Court decided a case called Rucho versus Common Cause in June of 2019, the month before we were supposed to start our trial. And in that case, that was out of North Carolina, very similar claims to ours. And that's the one where a majority of the court held for the first time there's no workable standard that they could identify for deciding when a legislature went too far, this was no longer a political question, but a violation of a constitutional right. They said partisan gerrymandering is a purely political question, and federal courts have no ability to be able to decide partisan gerrymandering claims. As a result, our case in Wisconsin, the Whitford case, did not go to trial again, and it was dismissed. So after the Rucho case, people will say, well, where do you go from there? What kind of claims could you possibly have if you can't bring a partisan gerrymandering claim in federal court? Well, the answer is, in part at least, claims under the Wisconsin Constitution. You could bring claims under a number of different articles in the Wisconsin Constitution: free speech provision, equal protection provision. There's a freedom of assembly provision in our Wisconsin Constitution. There's a free government provision also in our Wisconsin Constitution. So those claims remained as well. And claims new legislative districts could always be challenged in state courts under state or federal constitutional claims. and in the federal court, again, under the Voting Rights Act or racial gerrymandering claims. In addition, don't want to discount legislative options that exist. A state legislature in Wisconsin could amend the state constitution or could pass new statutes allowing districts to be drawn in a way that requires political neutrality. In addition, there have been new federal statutes that have been introduced. Moving on to the third court challenge now to try to get rid of these plans, this partisan gerrymander that was adopted in 2011. 2020, we had another census, and that means that districts had to be drawn new again. In the fall of 2021, the state legislature drew new districts. Governor Evers vetoed them. That means that that meant that the case had to go to the courts to be decided on what the new districts would be. We tried to bring those claims in the federal court here and have the federal court decide, but there were others who brought the claims in front of our state Supreme Court in what we call an original action. The state Supreme Court agreed to hear those claims, and because of principles that we have in federal law, where federal courts defer to state legislatures on these kinds of issues, the case proceeded in the state Supreme Court. And in the state Supreme Court, we got a ruling early in the case that was really very impactful. And that is that on November 30th of 2021, the state Supreme Court at that time, which was composed of a 4-3 conservative majority, said that the standard was going to be, to draw new districts, was going to be the least changes from the existing districts. In other words, it was going to receive proposed districts from all the different parties to the case, and that one of the criteria that it was going to require be followed was that those districts make the least changes from the existing districts. Well, when you make the least changes from a state map that already has a significant partisan gerrymander, you're going to end up with more of the same. It's not going to change it very much. In addition, the state Supreme Court said it would not take into account partisanship when it was evaluating the state legislative districts. So least change and not taking into account partisanship, what that meant is that the parties were very constrained in the kinds of districts that we could draw. So we did the best that we could. I represented a group of voters that brought claims and submitted maps. In addition, Governor Evers participated and drew proposed districts. On March 2nd of 2022, the state Supreme Court actually adopted the governor's proposed maps for the state legislative districts and the congressional districts. So those maps were put into place, but the legislature appealed to the United States Supreme Court on some issues having to do with Section 2 of the Voting Rights Act. And the United States Supreme Court agreed with the legislature that the state Supreme Court didn't do that voting rights analysis properly, and so it vacated the result. It sent the case back down to the state Supreme Court to reconsider. And when it did that, the state Supreme Court, again, a 4-3 conservative majority, ended up adopting the legislature's proposed maps. The irony being that the pro-Republican gerrymander in the legislature's proposed maps was even more extreme than what they had adopted in 2011. So that's where we were from April of 2022 until we mounted the fourth court challenge, which we did a little bit less even than a year ago. It's actually, the case is still ongoing, although it's been largely decided. And that's Clark versus Wisconsin Elections Commission. This was a case that we filed on August 2nd of 2023, so again, not even quite a year ago. And there had been a change in the state Supreme Court in April of 2023. We had an election, and Janet Protasewicz, who's the liberal candidate who was running at the time, we have nonpartisan judicial elections in Wisconsin, she defeated Dan Kelly. And so the makeup of the court changed, and it was a liberal majority as of August 1st, 2023. So we filed a petition for an original action on August 2nd, and we challenged the maps that the court had adopted in April of 2022. We challenged them on 3 grounds. We said, first of all, it's an unconstitutional partisan gerrymander. Second of all, 54 of the 99 districts were non-contiguous. Remember, I started out in the beginning by identifying some of the constitutional criteria for these districts. They've got to be composed of contiguous territory. And as it turns out, 54 of the 99 districts were not composed of contiguous territory. And we also said that by adopting the legislature's districts in April of 2022, those were districts that the governor had vetoed. And our argument was that by doing that, the state Supreme Court had violated separation of powers doctrine. On October 6th of 2023, the court granted our original action petition. In other words, it said it would hear the case. And also the legislature had filed a motion asking Justice Protasewicz to recuse herself from the case and not decide the case because of some comments that she had made on the campaign trail, and she declined to do that. We received a significant decision from the court, and this is just a little bit more than 5.5 months. And the court held something very significant. It held that the districts were unconstitutionally composed because they were non-contiguous. And so it said that's a violation of the state constitution, and it enjoined those districts from being used in future elections. It said it would take new proposed districts from the parties, and there were two significant changes or reversals that it made from that Johnson opinion in November of 2021. It said, first of all, least change is not good law. It never was good law, and it's not good law. And so it's not going to require districts to make the new proposed districts to make the least changes from existing districts. Second of all, it said that they would take into account the partisan makeup of districts. They said the court's got an obligation to ensure that the districts are not unfairly composed from a political standpoint to advantage one political party over another. The court also appointed 2 expert consultants to evaluate the proposed districts. And the parties submitted the proposed districts in January, and on February 1st of this year, the court-appointed consultants issued a report. And they said 4 of the plans, including one submitted by a group, the Clark Group, which I represented, the governor, the Senate Democrats, and another private group, those all satisfied the constitutional criteria, and they were neutral from a partisan standpoint. The consultants also said 2 of the plans submitted by the legislature and the Wisconsin Institute of Law and Liberty did not meet the constitutional criteria or the partisan neutrality requirement. And so seeing the writing on the wall, Assembly Speaker Robin Vos got his caucus to agree that they would adopt the governor's districts legislatively so that the court didn't end up doing it. And the Senate adopted those as well, and Governor Evers signed them into law. So the upshot is that as of February, we have new districts that are the first bipartisan districting legislation that we've had in 50 years. And I know Bob was waving the finger at me. And Bob, give me just one more minute because I want to run through this super quickly, just to show you sort of where we are in relation to where we've been over time. Partisan fairness. In the 1970s, measured by the efficiency gap, the plans that were in effect during the 1970s had about a 4% pro-democratic tilt to them. In the 1980s, it was about a 2% pro-democratic tilt. In the 1990s, the plans were basically perfectly balanced, no advantage for Republicans or Democrats. In the 2000s, we saw about a 6% pro-Republican efficiency gap. That was a court-adopted plan. 2010s, that was Act 43. It was about an 11% pro-Republican gap. The 2022 districts that the court adopted had a 13% pro-Republican tilt to them. And where are we now? With the new ones, this is still a slightly higher pro-Republican efficiency gap, 6.4%, but it's less than half of what it had under the plans that were adopted in 2022. And it's basically the same efficiency gap that we had in 2008 when Barack Obama was elected president on the national level, and on the state level in 2008, Democrats won the Assembly and the Senate. So the upshot is that the districts now are far more neutrally composed and far more competitive. And I'm just going to skip the congressional districts and we'll take questions.
Okay. Thank you, Doug. And that was 2 fingers. There were just a few questions. The first one is how are college students counted?
Well, it depends. College students, you can declare your residency where you want to declare your residency. There are certain, each state sets its own criteria for residency. In Wisconsin, we require you to be a resident for at least 28 days before the election. And so let's say we've got a student who's from St. Paul, Minnesota, and they're at the UW here in Madison, and they want to vote here. They can vote here as long as they're residency is here for voting purposes, so they've got to live in a voting district for at least 28 days, and they've got to register to vote here and satisfy their criteria, and they can't be registered to vote in Minnesota. So you have to have, again, there are other requirements that states have that are their own, but basically it's a choice that people can make. We see that a lot, by the way, in it's not just students, but it's snowbirds, people who have houses in the northern, up north, and they spent, or anywhere in Wisconsin really, and they have houses in Arizona or Florida. Where are they registered to vote? You can register to vote where you want to vote as long as you meet those states' requirements to qualify to vote there. But you can only be registered to vote in one state at a time. If you vote in a place where you're not registered to vote, it's a felony, and you don't want to do that.
No. Next was, can states redraw congressional districts more frequently than every 10 years?
States, the answer to that depends a little bit, in part on legislation. On litigation. One of the issues that we have, and this is kind of in the wake of, it goes back to the 2000 election, the Bush v. Gore case coming out of Florida. But basically, since then, we've had a constant state of litigation over what the districts look like. There is almost always at any given time litigation that's happening, and so the rules of when congressional districts get redrawn are actually set by federal law, and so if we have districts that aren't composed as they should be, for whatever the reason might be, maybe they violate the population equality, or maybe they constitute a racial gerrymander, whatever it might be, they can be redrawn, and sometimes they must be redrawn. As a matter of fact, there was a case that came out of South Carolina in the U.S. Supreme Court today. It wasn't a congressional district, but it had to do with districts that were drawn, back in 2021. So we're just sort of in a constant state of litigation here over those districts. As a matter of fact, when we won that ruling in the Clark case from the state Supreme Court in December over the composition of the assembly districts, assembly and Senate districts, there was a group that asked the state Supreme Court to reconsider the congressional districts in light of the ruling that it made in December. And our state Supreme Court declined to do that. They decided they were not going to revisit them. So at this point in time, there could be another challenge to those districts, and it's possible that they could have to be redrawn. But I think that it's most likely that those districts will be in place until 2031 when new districts are drawn.
Okay. And the last two questions that I have basically deal with the question of the and it's come up many times, the Iowa choice of having a neutral group design the maps. One was, is there a legislation that you believe would result in fair legislative maps in 2030? And the other one is do you think the heralded Iowa system redistricting would work in Wisconsin?
Well, there are a lot of different states that have commissions, or they draw legislative districts and congressional districts using some kind of a partisan neutral body. And the Iowa model is one that a lot of people hold up for a variety of different reasons. It was actually, there was a proposal, people might remember, from the legislative Republicans to put into place what they called an Iowa Model Commission. Number one, it wasn't really an Iowa Model Commission. Number two, the Iowa model is not really the best, when you listen to what the political scientists have to say, not really the best model. There's a model from Michigan that is really a preferable model. And so I think that if people are talking about a model, that's the one to look at. A model could be, that's something that could be adopted legislatively. And one thing that we might see, because districts now are going to be much more competitive in Wisconsin, because we have new districts that are in place for our elections this fall, that will see the legislature that will take office beginning in January 1st of 2025. And generally speaking, where you've got more competitive districts and where you've got a much closer vote in the Assembly and the Senate, you get much more cooperation between the caucuses in the Assembly and the Senate, and the likelihood that you get legislative solutions becomes greater. That's the theory, at least. And one of the ways in which the political parties, the caucuses, could decide that what's best for people of Wisconsin is that this is just sort of mutually assured destruction if we keep going forward with this, litigating everything. And maybe what they should do is to put in place a Michigan-style model or some kind of a model, so that we are taking the task of redistricting out of the hands of the partisan politicians, and we're putting in the hands of a nonpartisan commission. The legislature and the governor, I think if they could agree to do that, I think a lot of people would agree that that would be wonderful if they could do it. It could be done through a constitutional amendment as well, but the way we do things here in Wisconsin, it would require the legislature to actually vote on that first and adopt that first.
Okay. Well, thank you very much, Doug. That was most informative and a great update. And I will turn it back over to Diane now. Thank you again.
Thanks, Doug, for your presentation. Very good. Okay, the final part of our conference today is the Blair Teston Award. And it is my pleasure today to present that award to Robert Schaefer. Bob has garnered his experience from 33 years working for the DNR. He was involved in bargaining for the State Engineering Association during most of that time and directly involved in 8 or 9 contract negotiations. He has been on the WICOA board for about 14 years and served as the previous chair as we changed from face-to-face meetings to virtual meetings. Bob's goal is to encourage members to continue to be involved in their Wisconsin retirement system, the best and one of the largest in the US. Bob, congratulations.
My own cheering group here. I wish to thank the board of Wisconsin Coalition of Annuitants for selecting me to receive the Blair Teston Award. I have just a few comments. Mr. Teston was a far-sighted individual who helped public employees and the citizens of Wisconsin by creating one of the best defined benefit retirement programs in the US. We are fully funded and one of the least expensive because of Mr. Teston's efforts. Our shared risk makes us unique among retirement programs. We have the 9th largest pension system in the US. And for my part, I attend the meetings when I can just to show them that there is an interest by us in what they do at their meetings. My next point is for us. Our retirement benefit is a statute, not a constitutional right. And as we have seen in 1987 and in 2010, that benefit can be taken away or modified quickly. So we must stay involved and aware. And lastly, I wish the last point to thank the leadership and staff of ETF and SWIB for their efforts to keep the WRS strong. As Secretary Volker commented yesterday, the WRS is resilient, but we all have a responsibility to keep it that way. And thank you again.
Congratulations again, Bob, and well-deserved. So finally, thank you all for attending this virtual Wisconsin Coalition of Annuitants Conference. Please take a moment at the end of this session to complete our brief survey. When you press the red Leave button, you will be directed to the survey. Completing the survey will help with planning future informational meetings. Thank you again for attending and have a great day.